market for pound, what happened? Our demand has increased. See, we have a new value which is increased, right? So our exchange rate has increased. So one more time, if income rises, what happened? Demand for foreign currency rises, supply is unchanged, foreign exchange rises. Understand? Let's move forward. The last part is government controls. So government controls can also affect the exchange rate movements. Number one, imposing foreign exchange barriers. You cannot transfer currency or you cannot buy currency. Imposing foreign trade barriers. You cannot import from the UK, you cannot import from US, or you cannot import from China whatsoever. When trade is banned, so you can say that foreign currency is also affected, because when you import, then you will create demand for that currency. If import is banned, then how you can create the demand? And then intervening in foreign exchange markets. If the dollar is going down constantly, the government intervene into the market and saying that we need to stabilize our currency. Number last, it is affecting macro variables such as inflation, interest rates, and income levels. We know that the inflation has a separate effect on the exchange rate, interest rate has separate effect, income level have separate effect. But government can also trigger higher inflation by increasing more money supply. Government can also increase the interest rate or decrease the interest rate. Government can also increase the income level as well through minimum wage, right? Sorry. So these kind of government controls can also increase or decrease the value of exchange rate. So we have an example here. So government control example. So let me just read that. Recall the example in which US interest rate rose relative to British interest rates. The expected reaction was an increase in the supply of pound for sale to obtain more US dollar. What will happen when interest rate rises between two countries? Demand decreases, supply increases, and foreign currency decreases. So if the British government placed a heavy tax on interest income earned from foreign investments, if the UK says that there's going to be no flight of capital, which means you are not allowed to save with US banks and earn 10%, or if you're allowed to earn 10%, then there's going to be a tax on these 10% as well. Then people are discouraged to send their pound into US. It means this could discourage the exchange of the pound for dollar. It means even if the interest rate between these two countries are different, we don't see, in this case, we don't see a decrease in foreign exchange, the foreign currency prices, we don't see a decrease in foreign exchange, right? So if you understand this, please answer this question. Here we go. So let me read that. A large increase in income level in Mexico, along with no growth in the US income level, is normally expected to cause, assuming no change in interest rate or other factors, and Mexican demand for US goods and Mexican peso should. What is the answer?
I think it should remain the same, no?
Think about that. We just covered the income level. Okay, let me just make a graphical representation of this question. So we have US and we have Mexico. Right? A large increase in the income level in Mexico.
Oh,
Mexico
sir.
income level increased.
Sir.
Now, what happened? The Mexican will demand more goods from US. They can afford it. They're getting rich, right? So what happened? Everything is same, interest rates are same, inflation is same. What happened?
Mexico will increase the demand of US goods.
Good. It means answer going to be from A and B, right?
Yes.
And now, the value of peso. So remember, where are you? You are in
Mexico.
Mexico. Very nice. And for you, foreign currency is dollar. What we learned from our discussion regarding income levels, that when there is income level increase and no change in interest rate or inflation, demand for foreign currency rises, which means demand for dollar rises, supply of dollar, no change. And exchange rate for dollar increases. And here, what you are asking? You are asking foreign currency, you are asking home currency. This analysis is gonna be totally reverse. Peso will be, demand for peso will be decreased, supply is unchanged. So peso exchange rate will be decreased.
Depreciate.
Right? So the answer is A or B?
B.
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 Now you understand? Okay, the last part is the expectation. Expectations also increase or decrease the value of currency. So there are two kinds of expectation. One is called expectation based on investor perspective and also based on speculator's perspective. So we have both examples here as well. But overall effect is the same. Because the speculator, they believe in temporary gains, investor, they believe in long-term gains. So the end result is the same, just point of view is a little bit different. So expectations, if investors expect interest rates in one country to rise, interest rates, what will happen? They may invest in that country, leading to a rise in demand for foreign currency and increase in exchange rate for foreign currency. We know that if interest rate in that currency is higher, which means that for that country, exchange rate will be also higher. So impact of signals on currency speculations. What do we mean by signals? It means there is going to be sentiment in the market which signals that if everybody believes that currency is going to appreciate, then currency will appreciate. Why? Because there is common sentiment or common signals is that. So speculators may overreact to the signals, causing currency to be temporarily overvalued or undervalued. So we have example for both point of view, both perspective. Let's see that. Here we go. For investor perspective, the example is that investors may temporarily invest funds in Canada if they expect Canadian interest rate to increase. Such a rise may cause further capital flow to Canada. Understand? If you are in US and in Canada interest rate is higher, so what happened? Capital flow will move to Canada. There's going to be more money coming to Canada, which could place upward pressure on Canadian dollar. And why is that? Because US people, if there is only two countries in the world, US people will be selling their dollar and buying Canadian dollar. So they're going to be creating demand. If more demand means the value of the Canadian dollar will be increased. So by taking position based on expectations, investors can benefit from rise in Canadian dollar because they will have purchased Canadian dollar before the change occurred. So what happened? How you can just capitalize on this opportunity? So you expect that future rates going to be rise. So you invest right now. So that exchange rate is right now is lower. In future, it's going to be rise. Why? Because the Canadian central bank going to increase the interest rate. So you purchase right now, right? And when you purchase right now, and what happened? The interest rate does rise. You invest those Canadian dollar into Canada and receive the interest. And when you convert back to dollar, you will get two gains. One is interest, and one is due to appreciation of the currency of Canadian dollar, due to currency gain as well. Right? So although the investors face an obvious risk here that their expectation may be wrong, the point is that expectations can influence exchange rate because they commonly motivate institutional investors to take foreign currency positions. So let's read the speculator's perspective. So in spring 2010, Greece experienced a major debt crisis because it concerned that it could not repay its existing debt. So some institutional investors expected that Greece crisis might spread throughout the Eurozone, which could cause a flow of funds out of the Eurozone. So there were also concerns that Greece would abandon the euro as its currency, which caused additional concern for the investors who had investments in euro-denominated securities. So what happened? Due to this sentiment, due to this expectations, the speculators, they spread the rumors that whoever has the euro-denominated securities, they should sell that security. Why? Because euro currency gonna decrease in future. So what happened? Consequently, many institutional investors liquidated their investment in Eurozone. They sell their securities, the bonds, the shares. When they sell it, the supply of stocks and bonds increased.